Hello. Hi, Rishabh. A very good afternoon, Rishabh.
Hi, good afternoon. Hi, Preeti. How are you doing?
Very well. How are you, Rishabh?
Doing good. Thank you.
So looking forward to this session.
Yes, likewise. Thanks for having me here, and I have to thank Preeti for getting me here because she's followed up with me since the time that you met me at the D2C event, I think in Bombay, and after that you've been pretty you followed up quite a lot with me on this. So thank you for that, and it's a pleasure being here.
Thank you, Rishabh, for accepting my request. Rishabh, meet our mentor, Dhanuka sir. He
Hello,
has been,
Rishabh.
Hello,
Hello,
namaste.
Rishabh. Namaste.
yes, and we had the privilege of meeting your father, Mr. Harsh Mariwala, in 2020 during COVID times.
I see. Okay, I didn't know that. Okay, great.
Yes.
Fantastic.
Yeah.
Fantastic.
Yeah. So let us start the session.
Sure.
A very good afternoon to our guest of honor, our mentor, and all the members of Millennium Mams present today. Welcome to the first Zoom session of this year. And what a fantastic way to start the year with a session by none other than Mr. Rishabh Mariwala. Mr. Rishabh Mariwala is a second generation family business entrepreneur. He is a graduate from Zaab School of Business, Stra University, New York. In 2010, he became an entrepreneur. Along with his mother, he launched a new business line called Soap Opera. Very interesting name, catering to the masstige and luxury consumer segment. He launched his own beauty clinic label called Pure Sense in 2016. While working on Pure Sense, Rishabh founded Sharp Ventures, the Mariwala family office. He presently heads the same. He has also won the ET 40 Under 40 Award in 2021. Rishabh is on the board of Marico, an FMCG consumer company, and Kaya Skin Clinic, a cosmetic dermatology chain. Sharp Ventures is a multi-asset class investment firm with investments across leading funds, private companies, and listed equities in India and global markets. The firm manages the proprietary capital of Harsh Mariwala family, founder of Marico Limited, and is one of the India's most well-respected FMCG company with a market cap of $8.5 billion. With deep networks across entrepreneurial ecosystem, Sharp invests long-term patient capital and supports its portfolio company through multiple stages of their growth and evolution. The firm has delivered top returns across asset classes with early investments in industry-defining companies like Nykaa and Mama Earth. Coming to our organization, Rishabh, a very short introduction about our organization. Millennium Mams is a not-for-profit organization. It was founded in 1993 by our mentors, Mr. Bishnu Dhanuka and Mr. Sanjay Bhuwania, with the sole motive of creating financial awareness and literacy amongst women. The organization has grown multifold and has touched lives of more than 10,000 women since then, giving them an opportunity to build financial acumen. The curriculum imparts financial knowledge through the study of current affairs, business dailies, analysis of balance sheets, AGM participations, tracking of global economic trends, and factory visits. We have chapters in Kolkata, Mumbai, and Bangalore. And we invite industry stalwarts like you to increase the bandwidth of our knowledge and use this knowledge further for our studies. So welcome, Rishabh, to our forum. Rishabh, now the floor is yours for a keynote speech.
Thank you. Thanks so much, Preeti, and the founding members, and all you for attending. Really appreciate your time, and yeah, exciting to talk to all of you. I'm Preeti. I'm happy to. Would you like me to answer questions, or how would you like me to do it? There were some questions that came in, so
Yes.
I've thought through it from that format. So is that
Okay.
okay, or what would you like me to do?
Why not? Let us start with the Q&A.
Sure. I mean, whatever everyone wants. I'm fine either ways.
Yes, Rishabh, we would start with the Q&A. So for Q&A, I would like to invite my colleague and committee member from the Mumbai chapter, Arpita Meni. She would take it forward from here.
Hi,
Sure.
Rishabh. Um,
Hi.
Rishabh, so we at Millennium Mams, under the guidance of Mr. Bishnu Dhanuka, sir, and been following the Warren Buffett principles of investment, which is essentially investing long term in the capital markets. And we were very curious to know what has been your investment time frame at Sharp Ventures, knowing that you've been investing in various segments and sectors. What is it like, and how is it different from that of venture capitalists?
Sure, sure. So thanks. I hope everyone's just gotten an overview based on what Preeti was saying about what I do. But Alpita, if that's okay, I'll just give a slight overview about myself first, and
Sure.
without be without it being repetitive. But basically, the what we do is early stage venture capital. So I think I try not to be too technical about it, but it's investing in high risk companies which are early in the game, and by founders who are not the traditional small and medium enterprise owners. Or there's one school of thought where, say, a lot of the folks here as well, they would come from traditional businesses, right, where there'll be Marwadi, Gujarati businesses which are from Bombay, from Calcutta. I mean, that's what a little bit I've
Yes.
understood about Millennium Mams as well. And so this would not be the same, right? The true businesses are actually the ones that you all run, because the reality is these businesses are all based on profitability and based on pure business without external capital. So the businesses that you or your families or spouses or that you all do, or the families that a lot of the Millennium Mams are part of, they'd be more traditional from that lens.
Yes.
Mine is just more where you're giving growth capital, you're giving money to these entrepreneurs who come out of the IITs and IIMs and these institutes, but today they don't want to work in a McKinsey or a Unilever or a Marico or elsewhere. They want to work in venture capital because they believe that there's an idea, there's some problem statement, or there's something that's missing out there, where they can actually add value to something, that some unmet consumer. I mean, in our case, it's consumer because we invest in
Yes.
consumer businesses, but where there's an unmet consumer need.
Hmm.
So at Sharp, we invest in those businesses where they need capital, but it's a high velocity in terms of growth. So the traditional business will grow. It's sustainable because they actually grow at a slower pace, but it's more long term, and it takes
Mhm.
time to sort of build a large business. These businesses, either they can be like rocket ships where they can just go sky high and go for the moon, or they build very fast and then they can come crashing down. So
Right.
that's the risk that I'm taking, and that's the risk that venture capitalists take, because it is a high risk business. So I think that's just one thing that I wanted to just share with you, that it all these things, they sound super exciting and it sounds very cool, and in cocktail conversations we talk about startups, and we talk about how is this company built in 10 years time,
Yes.
grown so big. um but I think the real reality of it is that for every one success you see, there are 100 failures. And usually it's more the
Absolutely.
successes that are spoken about and not the failures. And that's why the barriers to entry, or the ability to choose the right entrepreneurs or the right cycle in terms of time also, where the business actually, where you invest, that has to be really thought through. Otherwise it could be it seems very exciting from the outside. And I think one of the questions that Pita was FOMO. So and FOMO, for most people will know, it's a millennial term, so the millennial mams will know it. But FOMO is fear of missing out. So there's FOMO and there's YOLO, which is you only live once. So we try to avoid FOMO and YOLO in our thought process, because these businesses are not something where you will hear about, you will talk about it. And I think today is one example where I can give, where business like Byju's, who everyone's heard of, at at its height, which is not even a year back, or a little bit less than a year back, it was $22 billion in terms of valuation. Today, that 22 billion has become 1 billion, right? So and I'm just putting this example, and just to make a point, But the reality is that we have to think through this very cautiously, and it is high risk. And the way in which we think about it is actually, one should go to bed at night thinking that okay, if this money is gone, that's actually okay. If this money is not there, that's actually fine, right? So
Okay.
if it all blows up, and that's the thought process that one should think through in terms of making these investments, because we have to make no mistake about it, it is high risk. So if that's the intent, then go for it. But there's a lot that goes into it, and I think, we all have friends and family and folks we speak to who, and we read the papers and watch the news, and all these things are very exciting. But the reality is that one should be very cautious in its approach. And because this is and I'm from South Bombay, I'm half Gujarati, so I appreciate the thought process. And because families are conservative, and
Yes.
rightfully so, right? Because the businesses that the families or that you all have built are just long-term sustainable, and you see some profit at the end of the day. These venture capital businesses, actually, you don't see profit for 10, 12 years. So one has to be able to stomach that and digest that before thinking about it, because the headlines look great, the numbers look great, but the reality is that you don't really know if you're going to make money or not.
Yeah, that's true. Thank you, Rishabh. That was like a great explanation to my question. I'd like to now call upon Nidhi Kanoi from our Mumbai committee to ask her next question.
Hi, Rishabh. So very excited to have you here. In fact, I think 1 hour is going to be too short. We'd love to have a longer interaction sometime soon with all our members from Kolkata, Bangalore, and Mumbai. So, Rishabh,
Sure.
I wanted to ask you, in your words, the family office is an investor class to reckon with, especially with regards to long term. So, what are the long-term bets we as new investors should look at, especially in this, these volatile times?
Yeah. So it's tough, because you want me to say, I mean, not from my perspective, but from your perspective,
No,
what one should
no, not at all. It could be from your perspective also. Just,
see.
we are fairly new in this
Yes.
investing journey for most of us.
Yes.
So that's
Yes.
where it comes in
No,
from.
I think that's totally fair. And I was talking to others, and I spoke to other sort of members who are part of Millennial Mams, and they were sort of asking me the same question in terms of okay, we have some spare capital, this is something that I want to take, their asset allocation could be, say, in mutual funds or these PMSs, or in public markets. Like, of course that's what one should do, because that is lesser risk, and the return is actually pretty good, right? The return is not, it's not a fixed deposit or some rental yield, or it's your return is much better, right? So I mean, my point would be that I think it's okay to play with some capital, but as long as you can sleep well at night if that gets lost. I think that's the first principle I
Absolutely.
would use to make a bet in the space. But again, if if you're coming from a place of competency, so for example, Nidhi, I don't know what is it that you do? Can I ask what you do?
I'm actually a CA. I have my own business, but right now I'm fully involved in Millennium Mams. I'm heading the Mumbai chapter for Millennium Mams right now.
I see, I see. So as a CA, you would come across, you would know other professionals who would say, I'm just making this up, right? You'd come across other professionals who would say, listen, we are a bunch of CAs, and we're starting up a business where we will render our services to other startups, for example, right? And this is itself is a startup, right? This hypothetical CA business. But Nidhi, we need your money. Can you give us some money? So then you would ask for the business plan, you would see the thought process, you would see their assumptions, you would see what they're doing, and you would seek other comparisons in India or the world, and say, okay, fine, this is how we need to build, this is the multiple, this is your ask, this is why I'm going to give you 10 lakhs or 50 lakhs or 1 crore or whatever, I don't know, whatever that number is,
Yeah,
right?
yeah.
And then you'd possibly make a call. But so the point I'm making is that if it would be someone saying something completely different from what you're doing, someone who's saying, listen, I'm starting a dance studio, I don't know, I'm starting a dance studio, and Nidhi, please give me some money.
Basically your area of competence is what you need
Yeah,
to.
exactly,
Yes.
exactly. That's the point.
Yes.
Yeah,
That's
yeah.
what
Thank you.
Buffett and Mr. Dhanuka keep repeating to us as well. Look at your
Exactly.
competency.
Exactly. So I think that's specifically required to actually go down this route of because you would appreciate the field that you're in, the industry you're in. You'll understand the dynamics much better than anyone else would. So I think that would be one. I think the other one would be, look, if I'm excited about everything and I don't know specifically what I want, or I don't, the space excites me and I have some spare capital, and listen, I really want to be part of this story and everyone's talking about it, and it's okay, it's fine if that money goes down, that's okay. I'm fine with that, but tell me how to participate. So I would say, you can interact with entrepreneurs and directly invest, but the other option would be to invest in a fund, because the learnings that you get from some of these funds is very high. They will have, I mean, and depends on fund to fund, but they would have engagements with they would call you to their annual days. You would meet other entrepreneurs there. You'd understand what they do. They would get onto calls where they update you on the performance of the portfolio. And I think that learning is also phenomenal. And frankly, that's how I learned, right? I've learned on the job. I'm not a CA. I'm not a finance professional. I could literally I could only spell venture capital when I started, right? So it's not rocket science, but at the same time, I do. I mean, there is a learning journey, of course, that's there, which one needs to, I think, appreciate. Yeah.
Perfect. Thank you so much, Rishabh.
Thank you.
I'd like to call upon Manjari from Mumbai for her next question.
Hi, Rishabh. Please excuse me. My video seems to be malfunctioning, so my video is switched off right now. Just carrying on from Nidhi's question, you yourself have built upon your own experience with soap opera and Marico's operations, using expertise developed there to evaluate early stage ventures in consumer tech, sustainability, and health tech. How do you
Yes.
see this evolving going forward?
Yes. So I think Manju, you're asking me about the space in general. How are these spaces going to move forward, or in terms of what we're doing at Sharp? I just wanted to
No,
clarify.
I'm talking about
Right.
what you're doing at Sharp. So right now your focus, a
I
large
see.
part of your portfolio
Yes.
comes from these four verticals, if you would call it that. So how do you
Yes.
see this evolving going forward?
Yes. So I think as we spoke earlier, in terms of competency and the circle of competency, I
Yes.
would actually stick to that. So that would be one, and I would consistently, there are two schools of thought. There's one school of thought, especially when you talk to these other funds, right, which say that, okay, fine, we are stage agnostic, we are sector agnostic, which means that they'll do everything from a restaurant chain to fintech to SaaS, which is software as a service, to health, to consumer, to EVs. They'll do everything.
Yes.
We have a different school of thought. We think that, listen, it's only when you approach something from competence, and competence leads to actually expertise, and expertise leads to actually value add, and value add actually leads to, it's a virtuous cycle, and that value add leads to actually you being able to, one, I think in that whole journey, right, of investing, one is actually decoding, right, who's
Yes.
the who do you want to back. And we probably get like over, I would say, in a month we probably get over maybe around 200 such mails that come to us, right,
Wow.
saying that, hey, can you
Okay.
invest in our business, blah blah blah. Right? So but then how do you decode that, and how do you break the clutter, right? Because
Yeah.
it's very challenging to do that if you don't really know the space. So
Yeah.
through knowing the space, one is then decoding in terms of, okay, fine, this is the right entrepreneur. She's really good at this. This is why she's excelling. This is the problem statement that she has. This is how she's going to solve it. And then backing her. That's one part. And then how do you add value to her in that process and in that journey as well, right? Because
Yeah.
this is a long game, right?
Absolutely.
This is an 8-10 year journey. I mean, to Arpita's sort of first question, right? This is the
Yeah.
8 to 10 year journey. I mean, businesses don't get built in I mean, and I'm sure all the millennial mams know this. All the members know this, because everyone comes from entrepreneurial families, and you all have seen either yourselves, your fathers, your spouses, your siblings, whatever, build these businesses, and they weren't built overnight. Rome was not built in a day, and they take time to get they take time to get scaled, right?
Yes.
So as a similar thought process happens, even if it's venture capital, it's actually the same. The problem is that a lot of the venture capitalists, I mean, in this field, if you have spoken to other folks who are doing this, they have a lower, their time horizon is much shorter. So they want,
Yes.
they'll say, okay, fine,
5 year.
you give us your money, yeah, we'll give you back in 5 years. But
Yeah.
I mean, if you just think about it from your own businesses, 5 years is a short span of time, right?
Yeah.
It can't get profitable and scale and make great returns and give that money back to investors. It's idealistic.
Yeah. If not foolish.
Yeah, yes.
Okay. Thank you.
I
Thank
don't know
you.
if that
Thank
answers the question.
No, it did. Basically, what I've understood is you're saying you're going to remain focused on your areas of expertise and competence, which at the moment is this. If you expand your area of competence into something else at a later point, it's a different one. But as of now, this is the area you're looking at.
Yeah, and there's enough to see. Yeah, exactly. So there's enough to see in the space where it's not like you're missing out, or there's not enough of stuff happening in the country. There's enough
Yeah.
and more to see, and there are enough moving parts in all these areas where it's actually overwhelming to even track these spaces. Forget more. So
Yeah.
the lesser the better. And then we'll build our core competence, and we'll build our expertise, and then be thought leaders in the spaces that we operate in.
Okay. Thank you so much.
Thanks, Rishabh. I'd like to call upon Preeti next for the question.
Hi, Rishabh. Rishabh, you have been investing in companies and helping them grow and evolve. So, what I want to understand and know from you is, how do you invest in yourself? Wherein, how do you grow and evolve? How do you invest in yourself?
Yeah. No, that's a great question. I mean, I think that's for everyone, all of us out there, right? Because we're so busy
Even
in
your
our
LinkedIn profile says invest in yourself, and so does mine.
Yes. No, spot on. I think if we don't give ourselves the time to invest in ourselves, and again, we have our businesses, we have our families. I mean, a lot of you are mothers here. I'm sure you invest in your children, in your spouses, but what about ourselves, right? So totally spot on. And I think for me, my journey is little, more. I think what other people also would do, but I think a lot of outside in. So one is what we do, but actually see what's happening outside. So I think maybe it could be either academic, where you're tracking other trends outside, you're just excited. For me, it's passion. I love consumer brands, so I love seeing what's happening all over the world. So I'll travel to the US, and I'll see, okay, fine, this is happening in America. It'll take 5 years to come to India, but it will come to India in 5 years time, right? So then it gives me a perspective which I otherwise don't have, because I'm so boxed into my sort of inside out thinking, that I won't never get a perspective of outside in. So I think that outside in thinking, to me, that's actually critical. That's one. Two is even being part of groups. I mean, like Millennial Mams, I think that's phenomenal that you're a part of this, and you all seem very close knit, and everyone seems to sort of work together out here in this group. But just peer learning is critical. So there are other organizations. I mean, Millennial Mams is fantastic. There's EO, which is Entrepreneurs Organization. There's YPO, which is Young Presidents Organization. There's, in fact, my father's organization called Ascent, which is ASCENT. So A for accelerating, SC for scaling, and ENT for entrepreneurs. And it's a peer-to-peer learning platform where basically we've got 1,000 entrepreneurs. We've got one chapter in Mumbai. We've got one chapter in Chennai. We're starting our Delhi chapter, and we've got an all India chapter where we have 1,000 members, and they meet on a monthly basis. But so say, Preeti, you have a 20 crore business, I have a 20 crore business, and you're doing services, I'm doing manufacturing. So there'll be 8-10 of us, right, from the same city, obviously, but we'll meet every month at a location of our choice. But you have to meet every month, and there's an agenda where we discuss work. But I'll tell you, listen, I'm going through this issue. Then you'll say, this is how I solved this issue when I was facing it, right? So I mean that peer-to-peer learning is critical because sometimes you can't talk to your friends or your spouses about it because whatever, there's enough and more to talk about with them, and sometimes they might not be interested in that. But like-minded thinking with other curated entrepreneurs is what we are building at Ascent, and I'm sure it's similar to Millennium Mams. But I mean, I think things like this are really exciting for members to learn from one another and to get that perspective, which otherwise we won't get because we either can't talk to our colleagues or our peers about it. But it's worthwhile to talk in a safe space like this to others and just openly air whatever is going through our minds or issues that we're facing or whatever.
Thank you. Thank you so much, Rishabh. Great ways. Great ways. Thank you.
I'd like to call upon Rachna next. Rachna Prasad.
Hi, Rishabh. Rishabh, as you said that you invest, hi. So as you said that you invest in businesses which has high velocity in terms of growth, definitely, and you avoid FOMO factor because of your business, like it needs a lot of patience. But any such incident where you missed investing in a business where still you're looking for an opportunity, definitely without any FOMO factor.
Yeah. So actually, maybe I'll talk about one is the FOMO, right? First, I'll talk about the FOMO because that's real, and that is true, and then I'll talk about certain categories that we've missed out on. But during COVID time when this whole edtech thing was there, I just discussed Byju's, and at that time Byju's was also growing. We actually did make the mistake, right, of getting into a sector which we didn't understand. So we did get into edtech. And we did make an investment at that time where we hadn't met the entrepreneur, and we met them on Zoom, but we hadn't physically met them. And sometimes that physical meeting is so critical, and Zoom only does that much. I mean, yeah, I would love to meet you all in a physical setting, but unfortunately because of my travel I couldn't. But I'm just saying that extends to all spheres of life, right? And especially in investing as well, because you can understand and learn about the person at least at the time of investing. So we actually there was a interesting edtech company by this gentleman in South Bombay, and he had the best people, he had the best investors who had supported him, and he came to us for money, and he said, wow, there's such great people there, look at where edtech is going, let's try to understand edtech. And very quickly within a month, and we did a lot of diligence, a lot of work on the deal. But we were sort of caught up in that FOMO zone, and we actually did that, right? We actually did that, and then so it's some of these lessons are hard learned. And that business, I think that was the first one to within a year of us investing. He had an all investor call. There were like 50 investors, and he said, sorry guys, I've blown up your money. I've spent all the money that you gave me. I spent like $15 million on IPL, on the IPL marketing campaign. And we were all shocked, right? So I mean, that was a true FOMO issue, and now that's why we've sort of learned the hard way, and we've said, okay, we won't do this going forward, but it's a hard lesson to be learned. So
we
I
all
mean,
have
at
to
least,
learn by burning our fingers as investors, definitely.
yeah. Well, I mean, the hope is that it's not with too much. You won't lose too much money.
Burn too
That's the
much
hope,
capital,
right?
yeah.
Exactly.
Absolutely. Thank you so much, Rishabh.
Okay.
Yeah,
I'd like
but
to
no,
call
to
upon.
answer. Yeah, sorry.
Sorry, go ahead, please, Rishabh.
No, so to answer Rachna's actual question was that what have we missed out on? So we have something called anti-portfolio, which is you will definitely miss out on some businesses because of lack of time, or because you don't have conviction, or because there's something that you didn't see. So I mean, for us, one of those deals, I mean, there were two deals that came to us, right? Where there were two gentlemen who were building a low-cost fan, and the low-cost fan, we said, okay, fine. Why would someone? I mean, this is India, but would I spend less just because the fan is the kharcha on the existing expenses for running the fan is sort of lower? Why would someone sign up for it, right? And we were proved completely wrong, right? It was a BLD motor, which is basically a different way of making the fan, which was unique to them. And then these guys have gone on to raise millions of dollars, and they've become a large business. And that business today is called Atomberg. I don't know if you've heard of it or not. It's a fan, but we missed out on that, right? Just because we didn't think low cost fans would be something that people would want to buy. So
Once again,
we Yeah, exactly. We live and learn. So yeah.
Yeah, okay. Okay, thank you. Thanks for sharing, Rishabh.
Thanks. Thank you.
Would like to call upon Shweta Sachdev.
Hi, Rishabh.
Hi.
Hi. As you mentioned about Byju's, my question to you is, what do you think about the valuation of these D2C companies in the current trend, where a lot of these new age consumer brands are breaking through new categories, and some of them are being publicly listed as well? See, our investment journey at Millennium Mams begins when yours kind of is ending, right? So we are interested to understand that how we should think about investing in these new age, newly listed companies. If you can throw some.
Yeah. Sure. So, I mean, there are two, three questions. One is saying that what do you think of valuations? What do you think of these new categories of consumer businesses now that they're listed? And then how should we think about our journey in this in this space, right? So let me just try to sort of give perspectives on all points. But I think valuations keep moving from time to time, and the valuations at any given point in time are a function of the quantum of capital that's present in the market. So, for example, in 2021, everything was absurd in terms of valuations just because there was domestic capital, there was external capital. You know, Flipkart IPO was happening. There was a lot of excitement on India, and these are not something that you, me, or anyone can control, right? These are all like large pension funds and sovereign funds from the US and all over the world that'll say, okay, fine, let's allocate to emerging markets, let's allocate to India, and because we allocate to India, let's pump in a couple of $1 billion into India, right? And they'll have some fund or someone else sort of giving money to the entrepreneurs, right? So it's a function of that. And when there's too much money in the market, then the market gets frothy. And so what that means is the valuations go up to unreasonable levels. And entrepreneurs are left with too much money, and too much of anything is never a good thing. So then they'll end up spraying that money and burning it, right? So I think it's a very negative downward spiral that takes place out there. Which again, you and I can't control, right? It's not a function of what you can do, what I can do. But today, what we see today in terms of the reality is that some of these multiples, even in consumer businesses, are 5 times the multiple, right? So the even like businesses, for example, that I've invested in today, the kind of the PE multiples that they are at when they've been listed, like a Mama Earth is at 10,500 crores, right? When it listed, is crazy. A 1,000 crore business being listed at 10,500 crores with no profit, with limited profitability, is absurd, frankly, right? If anyone's tracking the public markets, that's crazy. So because it's a multiple of the profit, but that multiple of profit is like, I don't know, it'll be like they'll only make some 100, not even like maybe 100 crores they'll make, but the valuation is 10,500 crores, right? So it's like it's unreal in terms of the multiple. So you can't justify that, and that's not what you and I can control. But so, and the intent, even me as an investor now, I'm lucky to have invested in these companies, but did I expect it to be at that kind of valuation? I did not. I mean, that's the reality. I didn't think that Nykaa would list at $14.5 billion, that Mama Earth would list at $2.5 billion. That's absurd. But it did happen, right? And I couldn't control it. But fine, I'm a happy investor because I made money. So we can't control it. But I think it depends on when you get in. I don't know if I'm answering your question, Shweta, but a 3, 4, 5x multiple of the top line, right? In early stage businesses, it's always a multiple of the top line, right, of the net revenue, and one should look at it from that perspective, not from the multiple on profitability, because that happens in mature businesses, not in earlier businesses. The earlier businesses only on the top line, not on the bottom line, not on the profitability. So I mean, that's one metric to look at in terms of why the multiple is what it is. But it's also by what the deals that have been done in the past, which you and I can't control because that's what the market has done. It's about going and asking around, okay, fine, in the same space, how did this business, what is the multiple of that business, right? And then it's a benchmark, and then companies use that as a benchmark for other similar companies in that same industry or sector.
Okay.
So
Yeah.
that's on the valuation part. And you said how do you how do you participate in this space, right?
Yes,
That
once
that's what I'm
listed
asking.
and yes.
No, so is it once listed or to get in early? What is the
Once
question?
it's listed, my question was, how do we, I mean, you've answered the question saying you look at the PE multiples of the revenue rather than the incomes. Because, for us, what you invest in is a very attractive space for us because we understand. I know you're very passionate about consumer space, especially being health, sorry, not even health, wellness. And we women, all of us are
Yeah.
actively sort of your customer base big time.
Yes.
So that's the reason I want to understand today. If I want to invest in a Mamaearth or in an ICA, what exactly should I look at? Because we invest
Yeah.
in the market. Yeah.
Got it. Yeah. So once it's the public market, then it's very different, right? Then it should be on profitability. So once it gets IPO, then it should be a multiple on the kind of profit. So even today, it's absurd the way in which Nykaa is also trading and some of these stocks are trading, right? But because there's so much euphoria in the market, there's so much money that's
Yeah.
coming to India that every stock is going up, right? So again, like to be honest with you, even I'm not an expert in this because I won't be able to understand why is the price so high. There's no rationale to the price being so high, but it's just a function of the quantum of capital coming into India, both domestic as well as foreign capital, and that's why it's gone up crazy. Like it's gone up to an absurd level at the moment. But like the tried and tested stocks, and there's limited stocks which are, because they're limited quality stocks in the market, everyone chases them. And I think that's the issue, that everyone chases those same respected stocks which are well governed, good corporate governance, good quality, good future prospects, and so there are those which get valued even higher and higher just because there's only such few stocks like that. So again, I don't have an answer to give in terms of how to look at it, because the valuations are absurd. But I mean, if it's well researched, depends if it's small. I mean, small caps and mid caps versus large caps, and large caps are more tried and trusted, sort of what one can bank on, an ICICI or a Titan or a Infosys or whatever. The large caps, HDFCs of the world, are a lot more sort of, you will know where it's going. It won't be volatile, versus some of these earlier ones where it's just a market sentiment and exuberance of the market.
So basically, stick to our Warren Buffett principles and invest in the companies we can stay for long term. That's.
Yeah, 100%. I mean, I follow the same philosophy, and frankly, I don't even, I leave it to my investment manager, and I don't go and I don't keep changing it, or I don't daily go and check the stock price and, oh my God, this has gone up so much, or should I sell, or this has gone down, should I sell right now? Like, that is just too much noise. And simplicity sometimes is just the best thing. It's best not to see that ticker on CNBC, because that will confuse the hell out of you.
Thank you so much. We all resonate with what you said. Yeah, thank you.
Thank you.
Let's call him Dineet from Bangalore.
Hi, Rishabh. Thank you for being so honest. Just to let you know that Mr. Dhanuka follows the same principles. So most of the Millennium Mams here believe in JOMO, not in FOMO. We are actually quite happy missing out on certain things because we know that's not our category. But thank you so much for all the questions that you've answered. My question is, what insight can you share on bringing legacy business experience like yours with startup agility for success?
Yeah. I mean, from where I sit, I mean, I'm seeing both those journeys, because I spend most of my time on the startups, and then even because I'm on the board of Marico and Kaya, and like Marico is like a larger company, Kaya is a mid-sized company, and I'm on the boards of both, and I think there's some time-tested principles, which again, it's just, I mean, maybe I'm not saying something out of the ordinary, or it's the most simple things, but I think it's relevant if you're a large business, a mid-sized business, or a startup. But just simple things to look at in terms of the fundamentals of the business. So I mean, again, it's simplistic, but profitability and unit economics is critical regardless of where you are. So the traditional businesses, they don't burn money to earn money. right? Versus these early stage businesses, they burn to earn. So I think, there's a lot that goes into, I think, what traditional businesses truly believe in. So when I talk to my father about the businesses that I'm investing in, he says, I don't understand what you're doing, because how are these businesses even alive today? And every time he looks at some businesses, I'm really worried about this. And I mean, if it wasn't for my success in one or two of them, he would have not given me more money to invest in, because uh, because a lot of them, you don't see, there's no path to profitability for a long period of time. So I think it's the time tested principles of, frugality, and I know it's very generic and very motherly statements I'm making here, but that's what I truly believe of. I think frugality, of just the grit of the, like, we look at the grit of the entrepreneurs, and just the ability to deal with people the right way, to deal with your own team, external vendors, making payments on time. I mean, those are just such, or even culture of the organization, right? Sometimes when you have organizations get toxic, and it's only performance based, I think it impacts everyone, from top down to below, and the culture always starts at the top. So I think that's just critical in terms of managing those softer aspects of the business, which often get overlooked because everything becomes too sort of, there's too much weightage on just like profitability or top line or growth. And I think sustainable growth is something that would definitely sign up for, versus growth which is sort of either sporadic or not incremental, but just lopsided in terms of very high growth and very volatile. Like that, I don't think that's something that's sustainable. So even sustainable growth, growing at a certain pace, I think those are things that often get overlooked. And I think the best companies in the world are able to truly embody the principles of growing at a right pace, and with the right team, with the right culture, and with the right mindset. I think it's I know it sounds simplistic, but I mean, this is what I've seen when I've looked at some of these businesses, and even things like with the founders also not doing too much, right? Just being focused on doing few things, and could be as simple as making coconut oil, which is what my father did, and just building a brand of coconut oil. He didn't get distracted with 10 other things. He just focused on coconut oil, when one would think, fine, where's the market for coconut oil in the country? And this is in the 80s, 90s, 2010, 2020, and it's still sort of growing, right? So I think that's what I've learned from him. But I mean, it's as simple as that.
No, thank you so much. Like, being simple and doing nothing is the most difficult thing to do, which is what we are learning here. But thank you. Thank you for your insight.
Thank you.
Would like to call upon Shraddha Podar from Calcutta.
Hi, Rishabh. Hi. In extension of Vineet's question, I would like you to mention some exceptional points you have noticed in the startups where you've got attracted to choose them. And also my another question is, what is your advice to new entrepreneurs to avoid getting affected by the shortage of funds?
Yeah. So shortage of funds, and the other one was for entrepreneurs.
No, so in your experience till now, what are the exceptional points you've noticed in startups which attracted you to choose them?
Got it. Yeah, so I'll start with the first one. So what made us choose certain startups, and why did we back the folks that we backed, right? Why did we back the players that we backed? So I think it's similar to what the previous question, right? Sometimes, I mean, it was for us. I mean, definitely, luck will play a role in it, right? You can't. Luck is definitely part of it, right? In terms of successful outcomes, and I think people forget that part where it's not that you're the smartest person in the room or you got the best skill set. I mean, luck does play a role, but that's one part of it for sure. But there are other parts as well. I would say, at least in our experience and in our journey, I would think it's actually just going and just appreciating the pain points of when the founder describes the pain point that they're trying to solve, and why they're doing what they're doing. So we've always tried to find a founder um, market fit. So does the founder is he or she relevant to the industry that they are working in?
Into, yeah.
And so, for example, if it's a service industry, is is consumer centricity or customer first mindset the top of mind value that the founder emulates? And if it is, then that's a great reason to actually, one of the reasons to back a founder, right? So I think, that's how we've looked at it, in the sense, in saying that okay, fine, do they have the chops, do they have the skill set to actually go out and build something from here? And yes, it is the right timing. The timing has to be right. Today, I mean, every second entrepreneur wants to be a beauty skincare entrepreneur. I'm sure you've seen many folks, and I'm sure a lot of some of the members out here would be as well. And I think it's a great time. But if you ask me, I think there's so much happening right now in the ecosystem. With that, it actually gets diluted, it gets even more difficult and even more challenging. So I think the right time and figuring out the right time, and there's an, I don't know, it's an art, it's a science, it's both. It's difficult to be prescriptive on that, but I think the right time, the founder market fit, seeing those qualities in the founder as well. Like we want to see frugality in the founder. Like we want to see, is the founder being frugal or not? I don't want the founder to I mean, I'm just being simplistic to make a point, but I don't want the founder to be on 30 different panels and fly all over the world and give talks everywhere and not, and you should be focusing on the business. Like the business is what the focus is on. Don't get distracted by the noise, because there's so much noise, right? It's just so easy to get distracted, right? So I think we want to founders to play the path of just going and executing and truly embodying what they've signed up for, right? So in terms of the business plan, where they're going with it, is it realistic or not? Will it actually pan out or not? And are they touching the numbers or not? I think we track those sort of things before we actually invest in them and invest behind them. So I think that's one part. Sorry if I'm being too slow, just tell me. And the other part is in terms of shortage of funds. So Shraddha, I think at least at our stage, we invest in businesses which would be anywhere between 50 to 100 crores in terms of their top line, right? In terms of their net revenue. So for them, I think you have to have some path in terms of, earlier on it would be like hand to mouth existence in terms of cash flows, right? Where you've got enough money just to sustain and just to stay, just to breathe, right? Just to be a little bit above water and not drown. So, but once you cross that stage where find this recurring revenue, there's repeat customers, there's you can see a line of sight and a line of growth also coming. Then you want, I mean, I think at 100, and depends. So it depends on the stage to answer, right? At a 20 crore mark is very different. I don't expect them to have 3 years of cash flow, right? But at a 100 crore mark, yeah, definitely you'd want them to have at least 2 years, 2 years of runway where they can invest in growth. I think that's how we look at it, at least from the space that we operate in, venture capital.
Okay. Thank you, Rishabh. Thank you.
Thank you.
Would like to call upon Vanshika Agarwal from Mumbai next.
Hi, Rishabh. Rishabh, my question to you was, you have the funds, you have all the options to invest, in different products across the board. How do you decide how to allocate funds to each strategy? Like, do you have a mechanism, or you just, it's a gut, or like, what is the standard method to do that?
Yeah. No, I think that's a great question. Because the biggest problem, I think, when you have excess capital is, today either it could be the flavor of the season, or your multiple family members saying, oh, real estate is so exciting, oh, debt is so exciting, oh, gold is so exciting, oh, something else is exciting, right? So how do you actually simplify it and just make it, I mean, one for your family or two for yourself also? Because I mean, you can also face the same issue saying that, listen, I have 50 lakhs, I don't know, whatever that number is, right? I have X amount of money, and now I want to do so much with it, I don't know where to do and what to do. So I think it's a function of the quantum of assets you have under you. And so I mean, I would look at it from a principled approach of risk and return, right? So what is your risk appetite, right? If you're okay losing that money overnight, then yes, do venture capital. If you're okay with some risk where, okay, fine, the markets can go up and down, but I won't lose sleep at night. I mean, that's the rule you should follow, right? Will today, if you're, I don't know, investing in, I don't know, like for example, Polycab. There was an issue with Polycab recently, right? If now Polycab has gone down all of a sudden, right? Oh my God, I've invested in Polycab. I'm not now. What's going to happen to me? I'm not going to sleep. Again, that's not the right approach. Then it should be more long term in the thought process, right? Yes, volatility will be there, but that's sometimes the function of the market. And if you don't want the volatility, then you can of course do mutual funds, you can do index funds. So again, from our end, if you ask me, Vanchika, we look at it from a risk and return angle. So we want high risk, we want high return. Now you can't expect to don't expect to outperform the markets. If you're in FD, then you'll say, okay, fine, I'm only going to get 5, 6, 7%. I might just beat inflation by 1% or whatever, and I'm okay. I'm happy to live with that, and that's totally fine. So it depends on your outlook, is how I would say it, because if I'm telling you what I do, then maybe I'm probably getting the wrong way, because my investment principles are based on how I see the world and how I perceive the market, and in terms of how much of risk capital I have, right? Which is different from what you have, right? Or different from what Arpita has or whoever else has, right? So, I mean, I would say it should be on again, like risk, return, competency. If I'm not competent, then can I give it to an external manager? So I am clear in my public markets. I don't want to be the decision maker, right? So I'm happy not taking calls. I'm happy not deciding. I'll tell a fund manager, here, you take my money. But this is what I don't want you to release. I don't want this. I'm okay if the market goes down by 20%. I'm not going to call you up and say, hey, wow, you've lost my money. You get what I'm saying? Like I won't do that. So, but tomorrow you might say, no, I'm okay with and it's totally fine if you're not okay with volatility. That's totally fine. There are instruments and products out there for that as well. So it depends on your outlook, but I would just say that it's about again, simplicity, competency, about what you can in-source versus what you can outsource. Like we've outsourced the public markets, I've in-sourced the private markets, which is the venture capital. Right. And then my risk and return. So I'm also not betting my entire capital only on even though I'm running my own, even though it's not like I'm giving it to somebody else, and I'm running my own capital in terms of investing in it, but that's a lower allocation to me than the public market. So my fund manager's got more money than of my own than I have of my own, because I trust him more with that, and the risk is much lower out there. So that's why I would have given him, allocated more money to him than to myself, because I'm not confident with the level of risk. I'm actually not confident enough to make a call that, yeah, I will return so much more than my fund manager, because the risk is lower with him because he's doing public markets alone, not venture, which is higher risk. So I think simplicity, competency, risk, and return, I think those are the 3 or 4 principles that I mean I would use to actually look at my one's asset allocation.
Great, Rishabh. Thank you so much.
Thank you.
I'd like to call upon Pooja Agarwal from Calcutta.
Hi, Pooja.
Rishabh, so you have had the opportunity to be in the traditional business as well as new age businesses. So to us, like the common investors, how would you like to guide us, like how to make money in the new age businesses or the traditional businesses? Where is the money for investors?
Yeah, I mean, again, that's that's a tough one, because again, it depends on what you know, right, Pooja? Like, how much do you study it? What do you study? Like, what do you enjoy and what do you study, and how much of your time do you put in? So, if you're putting your time in reading, in studying about the markets and talking to people regularly, if a decent quantum of your time is invested in that, then I think again, and again, I'm just going back to that same thing, right? Your risk and what is your risk appetite, what is your return appetite? But your risk should be a guiding principle to which you can say you want to invest in ABC. But I mean, so that's one. But twos, I would say keep it simple also, right? Don't try to do everything, right? Don't say, yes, I know gold, I know real estate, I know public markets, I know venture capital. The reality is no one knows everything, right? It's just too much to know. And if people who say they know that, they don't. So I would just say that just do one thing and do it well. I think and start small. Because of course those mistakes will happen, right? I mean, we've all made mistakes, and that's the only way to learn. But these are pools of capital, right? So you don't want to bet the house, you don't want to bet large quantums of money. But if it's small, then what we call like poker money. You start with poker money, that you're playing cards. Okay, fine, you'll bet 100,000, 5,000 rupees. Now would you bet 1 lakh rupees? I don't know. But you would bet it's okay to lose 5,000 rupees. I mean, everyone's got their own what they believe is okay to lose or not lose. That's their own personal barometer. But I think that's up to you to figure that out, and then based on that, the quantum of how much depth and how deep you go into that space. So I would not go down to say I think you should do ABC. That depending on you.
Thank you so much, Rishabh.
Thank you.
Thank you, Rishabh. Unfortunately, it looks like we're almost running out of time, and it was such an amazing session. I would like to now call upon Nisha Danish to give a vote of thanks. I wish we could continue more.
Sure. If you want to have other questions, I can answer. If there's any other questions.
Sure. We'd like to call upon Sunita Rock to ask her question then, and then Nisha can go ahead with a vote of thanks.
Arpita, her network seems to be patchy.
Okay, so no problem, Rishabh. I think we'll just go ahead with Nisha. Nisha wanted to really go ahead and give a vote of thanks.
Sure.
Good afternoon. I'd like to extend our heartfelt gratitude to Mr. Rishabh Mariwala for motivating and enlightening us with your valuable knowledge and expertise. It has been interactive, informative, and very enjoyable. It has been a pleasure at Millennium Mams to have you as our esteemed speaker. I'd like to thank Sir for giving us this opportunity to learn and flourish. The team members who have planned and organized this, we appreciate your contributions. Thank you to all members for taking time and attending the session and making it a wholesome experience for everyone. Thank you.
Thank you, everyone.
Thank you.
Thank you, Rishabh.
Thank you so much, Rishabh. Thank you so much.